everybody, welcome to PDX Unicorn. It's Tamara Stone and Hans Brunner yet again. Thanks again for joining us. Please like and subscribe. We have some really great information for you and we'll be dropping them occasionally for you to view. So if you want to get the information when it hits the YouTube, go ahead and hit that subscribe button. So we are going to talk about how to get pre-approved if you are self-employed, gig employment, all of the outside of the box sort of
Outside of the box, exactly. Yeah. I love painting outside the lines.
You know, Hans is really great. He's a broker, a mortgage broker, so he can shop your loan and he's got really great places where he can do that. And so he doesn't necessarily have to just fit you into this bank box in order to get you approved for a loan. So we're going to talk about that.
And that's why I love that's perfect. That's why I love being a broker, because I don't want to be in that bank box. And I love working with people that are also outside of that box.
I'm one of those people. My husband is a 1099 employee, but being a real estate agent means that I'm self-employed. And so there are some really interesting things having to do with that, because your CPA is going to tell you write off. But in the mortgage world, writing off everything isn't always in your greatest interest. We are not tax people. We can't give you any tax information, but just throwing that out there.
Yes, disclaimer, I am not giving any tax or legal advice.
Nope, me neither.
Period. You know, that being said, I can tell you what your tax returns, if, for instance, somebody who's a 1099 employee, we look at that as a self-employed person. And so if they earn $200,000, but they wrote off $180,000, we look at that as them making $20,000 a year.
That's your net income versus your gross income.
But I also just ran into a guy, he's a commercial fisherman in Ilwaco, and he went to his bank and the bank said, you lost money in 2020 and you didn't make that much in 2021. Well, he depreciates his boats and his truck, and he had a large amount, like $60,000 or $80,000 in depreciation, and that's a paper loss. So I get to add that back in.
That's nice.
So I qualified him no problem after spending about an hour with him, and his bank said no to him after 2 weeks.
And I tell clients this all the time. You always want to get more than one answer in terms of when you're looking for mortgages. And I always recommend going to a broker because they have the ability to shop your loan and they aren't pigeonholed. They don't have one arm tied behind their back and only being able to sell you the products that their potential firm has to offer.
Right, which is why I started as a broker, and then for 16 years I worked for direct lenders, and I would tell you how all the benefits. But now that I've been away from that for 6 months and back to the broker world, it's reinvigorated my excitement about my career because I can do all this for clients.
Yeah, it's nice. Tell us a little bit about some of your experiences. So we were talking before we got online here, we were talking about how some previous things where he worked with somebody who was married to somebody with bad credit. Tell us a little bit about that.
Oh yeah, so we were Tamara and I were talking about a loan program where we have a loan program that you don't even have to qualify for. As if you have a good enough credit and enough down payment, we can get you the loan. The rate's higher, but if you don't fit in the box, that's the most extreme example. I don't really want to go out there and promote that in a big way because that's the kind of loan that helped crash the economy in 2008.
The housing market, huh?
Yeah. And I was around, having done this for 32 years, I was there in that time. And so people would come to me during that time and say, hey, we can get this crazy loan. We want it. And I said no to people all the time. I remember one time that kind of a loan I got I can tell you that a school teacher, right, who made X amount of dollars per year, not a lot.
Not very much because they're a school teacher, unfortunately.
Exactly. So the school teacher wanted to buy a $650,000 house. And she had excellent credit and she had enough down payment and I could get her into this loan. But I had to look at her in the eye and say, you can't afford this on a monthly basis. Her husband made good money, had a white collar job, and he made good money, and together they could easily afford it. The problem was that he had terrible credit.
Yeah.
If we're looking at a conventional loan where you've got to fit in the box at your bank or credit union, they're only going to qualify on her income, and they don't qualify for the house they want, and they can afford. So I can remove the husband and get her a loan for this kind of crazy loan. So I want to know the whole story. I'm not going to just put somebody into an irresponsible loan. And that's why I survived, because I didn't do that back then. So we do have that on one extreme. On the other, not necessarily extremes, but there are people that write off so much. I mean, there's some businesses, you know, I've got a friend of mine who's an illustrator, and he works for, you know, big companies like Disney, and this will date me because this is back in the days of Blockbuster. But
I just had a memory on Facebook come up about switching from Blockbuster to Netflix and asking people how they thought about it. It's hilarious.
Well, he would go to Blockbuster and he would write off, you know, he would rent Disney movies for his kids to watch. He would write that off as research. So you can get really creative, and you can write off everything.
You can get really creative. Especially when you have a good CPA.
Yes. So the deal is that if there are instances where we can look at business bank statements or personal bank statements, and we can look at 6 months or 12 months or 24 months of bank statements, and look at the deposits and count that as income.
Which is great for all the gig employees out there. You know, people who aren't necessarily, I said my husband was a 1099. That's not what I meant. He is a W-2 employee. I said 1099.
He's in the box.
Yeah, he fits in the box. I do not. So the combination of the two of us, and I have great credit and he doesn't, but then our DTI, like there's so many things to take into consideration.
Yeah.
And so we go to Hans, and Hans says, well, here's what we can do for you.
Right. And so what we could do in that instance is, using you as an example, we could look at 12 months worth of bank statements and look at the deposits. But we also have another program where we can just look at your 1099 and say, that's your income. Because in this economy, a lot of people, I will have people come to me and they'll say, hey, I was working as an employee of IBM. They laid me off, but now I'm a contract employee with IBM and I make more money. And I say, yeah, that's great, but now you're self-employed.
Right. So the taxes that are involved, and paying your own insurance and all the stuff.
Well, not only that, but if you go to your bank, they'll say, oh, well, you're self-employed. You have to be self-employed for 2 years before we can help you.
2 years of self-employed taxes.
Tax returns turned in.
Yeah.
And to fit in that box, if we look at, you know, right now, if we look at 2 years worth of tax returns, we look at 2020 and 2021, and we look at the net, and we do a 2-year average. And if 2020 was too low, maybe we have to wait until early next year when you file your 2022s. But again, we have more flexibility. We just have a lot of options, and that's why being a broker is I'm excited about it.
Well, that's why I always send my clients to brokers, is so that they can shop the loan and get the best program that makes the most sense for each individual buyer, that you aren't necessarily having to fit into their box, but they can fit you into something that's out there.
To be completely transparent, when you're looking at, so we want to fit you in that box if we can, because we're going to get you the best interest rates. But even that box, we have a conventional box, a jumbo box, you know, USDA, FHA, VA. I just mentioned USDA, FHA, and VA. They're all a little bit more lenient on the debt ratios. On an FHA loan, you can have a little bit higher debt ratio, so you might qualify for more than on a conventional.
And isn't there something new happening with first-time home buyers as well? Like the way that they're looking at their income and debt and things are changing.
Yes.
So there's a little bit more leniency for the first-time home buyers.
And that's on the fit in the box, but on Fannie Mae, HomePath, and Freddie Mac. I forgot the name of it, but it's like that. But bottom line is, you get a little bit better interest rates.
Okay.
It's a little bit more lenient on credit scores. It's a little bit more lenient on other things. Some of those programs will even allow you to count rental income from renting out a room.
If it's your personal residence, your
primary residence, and you rent out a room. Tamara's nodding her head like, oh, that's great. But you guys might not know that we typically, if you rent out a room in your house, we, as you know, your bank and credit union won't count it. Conventional loans don't count that. but there's all kinds of different ways to go. And having done this for 3 decades, I love having access to hundreds of different wholesale lenders, because when one lender comes out with some unique product, I understand exactly how that's going to translate for you guys and what we can do and all of the different, things. I mean, we've talked about 3-2-1 buy downs and different things to help somebody qualify. There are different kinds of loan programs.
Absolutely.
You don't want to look at it like, okay, we're talking about a 30-year loan, but you're not going to have it for 30 years.
Yeah. Oh man, we were talking about that. Like, there are some people who, when we're quoting them for 30-year loans and talking in terms of refinancing and things, and they're like, well, I'm going to have this loan for 30 years. Rarely ever does it happen. It does happen occasionally, but I think most people don't even stay in their house for more than 5 years, so you're not going to keep, in that instance, you don't take that loan with you. Hopefully not.
Right.
You sell your house for more than you bought it for, and then you pay off that loan and you move on to something else. But a lot of times, especially now with the interest rates creeping up, they're still kind of historically low, just FYI. I mean, we're still not in the 8s, which we have seen a lot of historically. So things are still good. They're just not as good as they were previously in the COVID years. They're still potentially going to go down, and they do fluctuate, but most of the time you don't stay in a house or in a mortgage for 30 years. And you can refinance, you can do things like a HELOC. Do we know what a HELOC is? What's a HELOC?
Home equity line of credit.
And what does that mean? You have to have equity in your house, and then you draw that equity out to do whatever you want with it, as long as you can pay back the amount.
Exactly. So actually, that's a great segue, because what if you bought your house in 2018 and you refinanced it in 20 or 21 with this really low interest rate? Now you've got all this equity, and you go, oh my God, I don't want a loan in the high 6s or low 7s to pull that cash out. Well, we can get you a home equity line of credit to pull the cash out. You keep your first mortgage in place, and now you've got a way to pull cash out, whether you're going to use that to, add a deck or fix your roof or buy another house.
Or buy a boat. We just bought a boat. So we went in on it with some people, though. So anyway, we didn't take a HELOC out to do it. But
well, and one thing that you were talking about, interest rates being historically low, that does kind of get maybe when people go, oh my God, the rates are so high.
Yeah.
And compared to last year at this time, yes. They are so high. It was in January that the world just changed. But what we were expecting is a couple things. Well, first, to give you some insight, in the early 80s, when I was in high school, I wasn't in the mortgage business, but the rates were in the 18, 19, 20% range.
Yes.
I got into the mortgage business in 90, and I remember it was either 91 or 92, we were celebrating when interest rates got into single digits.
Yeah.
So when I remember making a flyer and running out to all my real estate agents' offices and putting flyers in their boxes, 9.875 for 30-year fix.
Did it!
Yes. So we were super, super excited about just having it not be double digits.
And I saw something flying around. I actually posted it on my Facebook page, and it was talking about how if a house was on the market last year at $550,000 and you got into it at $650,000 at this much lower rate, but now the house is on the market for $550,000 and you get it for $525,000 at a higher rate, you're still not paying as much for that house monthly than you would have had you paid over asking for it at that lower interest rate. So really interesting to think about these things in terms of holistically, as opposed to just that the interest rates are high. On top of, we can help Hans can, I can't help you. Hans can help you get as low of an interest rate as possible and kind of coach you on some things, like you might need to lower your debt to income, you might need to increase your credit score, and then give you some tips on who to talk to in order to make sure that those things get done correctly, and then have a relook at it a couple months later to get you into the best interest rate possible. And then talking to me about, okay, well, because I tell my clients all the time, it doesn't matter what you get qualified for. He might say, you can spend $1 million, But you come to me and say, I only want to spend $500,000. Okay, I'm going to go with your $500,000. He's going to say, sure, they're pre-approved for that. And I'm going to say, okay, that's how much you want to spend, and that's what we're going to roll with. So even though you might end up having a higher interest rate at a really high pre-approval, as long as you can make that mortgage, you're comfortable with it, and that's how much you want to spend, that's what we're going to help you buy.
We were talking about coaching. What if, massaging your credit and giving you ideas about what you can do to build your credit, etc. The first thing that I would say is don't do that. Don't go fix your credit on your own. Let's talk about it, because
there are some really interesting things that you might think are the best way to go about it, which are really going to hurt your credit.
Yes.
Like closing accounts.
Like closing accounts, because we look at your credit history. Now you closed accounts, now your credit history is less. So that's going to typically lower your credit score. One that's crazy to me, it's not crazy to me because I'm used to it, but it's crazy probably to you, is that let's say you have a $800 collection account from 5 years ago, and you were mad at your dentist and you don't feel like you owe them and you never paid it.
Yeah.
And so now it's this 5-year-old $800 collection, and it doesn't look good on there. So you say, I'm going to pay it off and raise my credit score. Guess what happens?
It starts the number over again.
Fresh activity.
Yeah.
So now you have a 1-month-old collection in the way, or 1-month activity, and your credit score goes down after you paid off that collection. So there's just don't do anything. Let's talk.
Yes. Come chat with us. Comment below. If you have any questions, like and subscribe always. And then I'll have Hans's information at the bottom of this so that you can get a hold of him if and when you're interested in talking about getting yourself a mortgage, whether you are 1099 or self-employed or however you want to call that.
Yeah, and I love talking to self-employed people. I want to start, if we talk now, you may have a plan to get from here to there. I'm not going to tell you, probably not going to tell you oh, you got to go completely different direction. But if I move you 1 degree to the left and you go on that path for the next 12 months, you're in a completely different place than you would have been had you stayed on your own path.
Yeah.
So I'm happy to have that conversation up front.
Don't be scared. Don't be scared to come contact us. We might just say not now, but we can help you get there eventually, so that then the answer will eventually turn to yes. Well, thanks for sticking around with us, and we hope to work with you soon.